friends, welcome to the world of business studies by my YouTube channel Clear Concept. In the last discussion, we have covered few topics of NCERT BST Part 2 Chapter 9. The topics were meaning of business finance, meaning of financial management and the role of financial management. Now, meaning of financial management. I'll be giving you a short review on this. Business finance refers to the money and credit employed in business. It involves procurement and utilization of funds so that business firm may be able to carry out their operations effectively and efficiently. Next is finance management. Financial management means planning, organizing, directing and controlling the financial activities such as procurement and utilization of funds of the enterprise. It means applying general management principles to the financial resources of the enterprise. Next that we have covered was the role of financial management. The size as well as the composition of fixed assets of the business, the quantum of current assets as well as the breakup into cash inventories and receivables, the amount of long-term and short-term financing to be used, breakup of long-term finance into debts and equity, etc. All the items in the profit and loss account, example interest, expense, depreciation, etc. Now, the topics which we are going to cover today is objectives of financial management, financial decisions, and factors affecting investment decisions. Now, let's move to the first slide and I'll be explaining you the objective of financial management. These are the few points are the objectives of financial management. The first one is profit maximization. One of the basic objective of financial management is profit maximization. The company should earn sufficient profit for meeting its expense, expansion and modernization. Profit can be maximized with the proper utilization of organization resources. Now the next point, that is wealth maximization. Wealth maximization is yet another basic objective of financial management. Wealth maximization means the maximization of the market value of the share, the market value of the market value of the shares is related to three financial decisions like investment decision, financing decision and dividend decision. In short market, value of share increases if the benefits from a decision exceeds the cost involved. The next point, that is proper utilization of total financial requirement. Proper estimation of both fixed and working capital requirement is an important objective of financial management. The financial manager must find out how much finance is required to start and run the business. Estimating the financial requirement is done after considering various factors such as type of technology, scale, operation, manpower requirement, etc. Now the next point, that is obtaining fund at a minimum cost. Obtaining the fund or mobilizing the finance is also an important objective of financial management. The required finance can be mobilized from many sources such as share, debenture, bank loan, etc. There must be a proper balance between owned finance and borrowed finance. The company must borrow funds at a low rate of interest. Next, that is proper utilization of finance. An important objective of finance management is optimum utilization of finance. The finance manager must invest the organization's finance in profitable projects. He should always adopt caution and safe financial policies. Next, that is maintaining proper inflow and outflow of cash. The organization must have a proper inflow to pay the day-to-day expense such as purchase of raw material, payment of wages and salaries, rent, electricity bill, etc. A healthy cash flow improves organization survival and success. Next, that is risk minimization through creation of reserves. One of the objectives of financial management is to create reserves. The company must not distribute the entire profit as dividend to the shareholders. A proportion of the profit must be kept aside as a reserve in order to use for future growth and expansion and to face the contingencies in the future. Next, that is proper coordination. Financial management is an integral part of overall management. In addition to raising funds, the financial management is directly concerned with production, marketing, personnel, etc. Thus, proper coordination with the department or the other department is an important objective of financial management. Next, that is financial control. Financial management should always plan the source of procuring funds and also the application of funds. Deviation between the planned and the actual flow and outflow of funds should be studied and analyzed, and corrective action should be taken immediately. Next, that is creation of goodwill. Financial management must try to create a goodwill for the organization. Goodwill helps to survive in the short term and succeed in the long term. These were all the objectives of financial management. Now we'll move to the next slide, that is financial decisions. Basically, there are three types of financial decisions, like investment decision, financing decision, and dividend decision. I'll be explaining you all these three decisions one by one. Now moving to the first one, that is investment decision. The investment decision relates to how the firm's funds are invested in different assets. Investment decisions can be long-term investment decision. It is also called as capital budgeting decision. These decisions involve investment in fixed assets which has long-term implications. For example, replacement of existing machine or acquiring a new fixed asset or opening a new branch, etc. All these involve long-term investment. These decisions normally involve huge amount of investment and they affect earning capacity of the business. Therefore, these decisions are to be taken with uttermost care. Short-term investment decisions are also called working capital decisions. These decisions involve investment in current assets and immediate return can be expected from such investment. For examples, investment in current assets such as cash, receivables, and inventories. These decisions affect the day-to-day working as well as liquidity and profitability of the business. Now the next decision, that is financing decision. Financing decision is concerned with the financing of business activities and the quantum of finance to be raised from the various sources of finance. The main sources of funds for an organization are shareholders' fund, owners' fund, it is also known as owners' fund, and the borrowed funds, which is also known as debt fund. The shareholder funds refers to the equity capital and the retained earnings. Borrowed funds refers to the finance raised through the debentures or the other forms of debts. A firm has to decide the right proportion between these two important sources of finance, like owner's fund and the debt fund, by equating different factors affecting financial decisions or financing decisions such as cost, risk, effects on management control, state of capital market, etc. Thus, these financing decisions determines the overall cost of the capital and financial risk. Now, let's move to the third type of decision, that is dividend decision. Dividend decisions relate to the appropriation of profit. Dividend is that proportion of the profit which is distributed to the dividend constitutes the sources of internal financing. Dividend decisions relate to what part of profit should be retained in the organization and what part it should be declared as a dividend. Retained earning increases the future earning capacity of the organizations, whereas dividend result in maximizing shareholders' wealth. Hence, the finance manager has to take balanced dividend decisions so as the owners should get reasonable return on the investments and need of the business should not be suffered. Now, these were all about the three types of financial decision. Now, let's move to the next slide, that is factors affecting investment decisions. Basically, there are three factors which affect the investment decision. First one is cash flow of the project, the second one is the rate of return, and the third one is investment criteria. I'll be explaining you all these three in detail one by one. Let's move to the first point, that is cash flow of the project. While making a choice of the capital structure, the future cash flow position should be kept in mind. Debt capital should be used only if the cash flow position is really good, because a lot of cash is needed in order to make payment of interest and refund of capital. Now the next point, that is return, the rate of return. It is also known as ROI. The greater rate of return on investment of a company increases its capacity to utilize more debt capital. The calculation of return on investment is made with the help of the following formula, whereas ROI, return on investment, is equals to EBIT upon total investment. Now the third point, that is the investment criteria involved. The decision to invest in the particular project involves a number of calculations regarding the amount of investment, interest rate, cash flow, and rate of return. There are different techniques to evaluate investment proposals, which are also known as capital budgeting techniques. These techniques are applied to each proportion before selecting a particular project. Now, in the next discussion, I'll be covering the topics like factors affecting financial decision, factor affecting dividend decision, and financial planning meaning. Let us know your doubt or any specific query below in the comment section. Subscribe us and ring the bell button so that you won't miss any important update. Till then, enjoy studying business studies.